Let me ask you a question. What language do Google, Apple, and pretty much every major company on the planet use to talk to the world? To tell us how they're doing, what their plans are. It's not English, it's not Mandarin, it's something that connects all of them. It's the language of business, and that language is accounting. Yep, it's the universal way that companies tell their stories. Stories of wins, losses, of growth, and value. And hey, once you learn to speak it, this whole new world of understanding just opens right up.
Hey everyone, and welcome. In this explainer, we're going to be diving straight into the FMAA curriculum, starting with Section A to lay down the absolute essential building blocks of accounting. Think of this as your Lesson 1 in becoming fluent in the language of business.
So here's our game plan. We're going to start with the absolute foundation of what accounting even is. Then we'll meet the different players or business types. After that, we'll learn the rules of the game, build up our core vocabulary, and finally, see how it all comes together to record transactions. Ready? Let's jump in.
All right, first things first, the foundation. Before you can start speaking any language, you've got to understand what it's all about, right? What is it, and who are you even talking to?
So what is accounting, really? Well, here's the formal definition. The process of recording financial transactions pertaining to a business. It includes summarizing, analyzing, and reporting these transactions. Okay, I know that sounds a little dry, but what does that actually mean? It means accounting is the magic that takes all the chaos of a company's daily life, every single sale, every bill, every paycheck, and turns it into a clear, understandable story about that company's financial health. Now, this language of business, it actually has a couple of different dialects. First, there's financial accounting. Think of this as the formal, polished speech you give to outsiders, investors, banks, the government. It has super strict rules, and it's all about reporting what's already happened. It's the official history book. Then you have managerial accounting. This is the internal chatter, the strategy session. It's for the managers inside the company making decisions about the future. It's way more flexible and all about planning the next move.
Okay, so we know what the language is for. Now let's meet the main speakers. Because the way a business is legally set up, well, that completely changes how its financial story gets told. And more importantly, who's responsible for it.
Kicking things off with the simplest one, the sole proprietorship. This is basically a one-person show. Think of a freelance developer or a solo graphic designer. Now, the key thing to get here is that, in the eyes of the law, the business and the owner are the exact same thing. The business's profit is the owner's personal income.
Then we've got the heavyweight, the corporation. This is a huge leap because a corporation is a legal entity that is separate and distinct from its owners. It's basically its own legal person, and that's a massive deal. It means if the company gets into trouble, the owner's personal stuff, their house, their car, is safe. This idea is called limited liability, and it is an absolute game changer.
And sitting right in the middle, you've got the partnership. The name says it all, right? It's a formal setup where two or more people get together to run a business and share the profits. It's kind of like a sole proprietorship, but for a team. And there are different types, some of which even offer a little bit of that limited liability we just talked about.
This table really breaks it all down. But let's zero in on that liability row, because that's the big one. See that? For a sole proprietorship, it's unlimited. The owner is on the hook for everything. But for a corporation, it's limited. The business itself is on the hook. And check out taxation. For the first two, the profits pass through to the owners to pay taxes on. A corporation, it pays its own taxes. These distinctions are absolutely critical.
So, we have our speakers. Now we need the rules. If accounting is a language, then you can think of accounting principles as its grammar. They're the structure that makes sure everyone is telling their financial story in a way that we can all understand.
In the United States, the main rulebook is called GAAP. It stands for Generally Accepted Accounting Principles. But honestly, just remember GAAP. This is the set of standards that make sure everyone is playing by the same rules. It creates consistency, so an investor in New York can look at a company in California and know for sure that they're comparing apples to apples.
Now, one of the biggest rules inside of GAAP is all about timing. It's this concept of cash basis versus accrual basis. Cash basis is simple. You record a sale when the cash actually hits your bank account. But GAAP says, nope, you got to use the accrual basis. So, let's say your company finishes a huge project in December, but you don't actually get paid for it until January. On a cash basis, that revenue is from January. But on an accrual basis, you record that revenue in December when you earned it. See the difference? Accrual gives a much more accurate and honest picture of how the business actually performed during the year.
All right, we've got our speakers, we've got our grammar. What's next? The vocabulary. It's time to learn the core words, the absolute nouns of accounting that everything else is built on. First word, asset.
Super simple. An asset is just stuff the company owns that has value. Let's invent a tech company. We'll call it Apex Innovations. What are its assets? Well, the cash in its bank account, the powerful computers its engineers use, its valuable patents, and the building where it makes its products. All assets.
Next up, liability. And you could probably guess this one. It's the opposite of an asset. It's not what you own, it's what you owe. So for our company Apex Innovations, what's a liability? That big bank loan it took out for the factory? Yep. The money it owes a supplier for a shipment of microchips? For sure. Even the paychecks it owes its employees at the end of the month, that's a liability.
And our third keyword is equity. Basically, equity is the owner's piece of the pie. The fancy term is residual interest, but all that really means is it's what's left over. Imagine you took all of Apex's assets, sold them for cash, and then used that cash to pay off all of its liabilities. Whatever money is left in that pile, that's the equity. It's the company's net worth.
And here we go. These three words, assets, liabilities, and equity, come together to form the single most important concept in all of accounting, the accounting equation. Assets equals liabilities plus equity. Now, this isn't a suggestion. It's like a law of physics for business. This equation must always be in balance. Everything a company owns has a claim against it, either by someone it owes money to or by the owners themselves.
Okay, we've got the grammar, we've got the vocabulary. So how do we actually start talking? How do we take all the things that happen in a business every single day and start recording them using this language?
First, we need to clear up something that trips a lot of people up: the difference between bookkeeping and accounting. They are not the same thing. Think of it like this. Bookkeeping is like writing in a diary. You're just recording the facts of what happened each day. Accounting is reading that diary, analyzing it, finding the patterns, and then writing the official biography of the company. Bookkeeping is the what. Accounting is the so what.
To record things, we use a system of debits and credits. Okay, deep breath. I want you to forget whatever you think these words mean. Forget good and bad or plus and minus. In the world of accounting, debit simply means left and credit simply means right. That is it. Left side of an account, right side of an account. This whole system is just a clever way to make sure that for every transaction, our big equation stays perfectly in balance. As you can see from this table, a debit, putting a number on the left, increases an asset, but it decreases a liability.
And because of this left and right system, every type of account has what we call a normal balance. That's just the side, debit or credit, that makes the account go up. So if you look at the chart, you'll see assets have a normal debit balance because debits make them bigger. And on the flip side, liabilities and equity have a normal credit balance. Getting this down is a huge shortcut for understanding transactions, trust me.
Now, all of this recording doesn't just happen randomly. It follows a very clear, repeatable process called the accounting cycle. It's an 8-step journey that takes one single business transaction and carries it all the way through the system until it ends up on the official financial statements. So far today, we've really only scratched the surface of steps 1 and 2.
So let's recap. We've got the essential building blocks. We know the players, the rules, and the vocabulary. We even know how to record individual transactions. But after a company goes through a whole month with maybe thousands of transactions, how can we possibly be sure that our fundamental law, assets equals liabilities plus equity, is still in balance? How do we check our work? Well, that first big test is called the unadjusted trial balance. And that is exactly what we're going to tackle in our next FMAA explainer. See you.